this year for gross fixed capital formation. And the share of government final consumption expenditure has indeed come down slightly. What you see here is the 5-year, that is starting from the financial year 2019-20, 5-year compounded annual growth rate. I think what you see on the right side bottom and as well as on the left side bottom is that the gross value added at basic prices as well as GDP are quite clearly putting behind the contraction induced by the COVID pandemic, which affected to some extent the growth rates in the first quarters of 2020-21 and 21-22. And that is now behind us, and both the GDA and GDP are continuing to accelerate and heading towards their overall trend growth rate. As far as the prospective growth is concerned, I think although agricultural growth in real terms year on year was 2% in the first quarter of this financial year, going forward, given the fact that there are very few deficit monsoon subdivisions and most divisions have experienced normal rainfall, the sowing of pulses and cereals is higher than last year. Year-on-year growth rate being 5.7 and 4.4% respectively, and the reservoir storage levels being higher than last year's as well as the 10-year average. I think the agriculture and allied sectors will see a rebound in their growth rates as we head further into the financial year. And if you look at the growth on the supply side, the manufacturing sector is continuing to remain in expansionary territory, a very steady expansionary phase. The 14.8% year-on-year growth in steel consumption is also an indicator of robust industry demand. And the production index of the core industries as well as the index of industrial production are going at mid-single digit growth rates. And there is a just increase in cement production as well. On the next slide, those who are not speaking, can you please?
Yes, ma'am. Please put your microphone on mute, please.
The services sector growth remains upbeat, even stronger than the manufacturing PMI index showed, and there is continued robust growth in digital transactions in terms of volume and value as well. Foreign tourist arrivals has picked up, hotel occupancy rate remains steady at the same levels as last year, and both port traffic and air cargo traffic have picked up quite well compared to the FY24. In FY25, they have registered growth rates. Passenger vehicle sales, this we are talking about the demand side. Passenger auto sales remain steady compared to last year. Housing sales have registered a 42% increase, and that partially also explains the strength in the construction sector growth rate, which picked up to 10.5% this year compared to 8.6% in the first quarter of last year. And there is a healthy growth in the air passenger traffic on the domestic side as well. In terms of urban and rural consumption, we continue to see a good pickup in the rural consumption, as we are seeing in the last 5 quarters of data, starting from the first quarter of FY24 on the left side. And in the two-wheeler segment, which is usually considered to be a proxy for rural consumption, two-wheeler sales in the first 4 months of FY25 are higher than the two-wheeler sales in rural India in FY24. So this year, in the first 4 months, rural two-wheeler sales has been higher than that of last year. And there is a modest rise in tractor sales over already a fairly high base as well. So rural consumption has indeed stabilized and has been improving and a good monsoon will give further fillip to rural and therefore overall consumption in the coming quarters. As far as inflation is concerned, the headline inflation rate has been trending down. So has been the food inflation rate recently in the last month. The July food inflation, as reported in August, has come down quite significantly, sharply due to decline in vegetable inflation. And core inflation rate hasn't really shown any sign of spillover effect from food inflation. It has remained at around 3.3%. So the fear of food inflation spilling over into rest of the inflation hasn't really been borne out in the data. And if you look at the monetary policy transmission, therefore, is evident in the declining core inflation rate. Inflation expectations have inched up slightly. Again, it may be reflecting transient factors, but overall, the inflation rate expectations remain below last year levels based on households' inflation expectations survey of the central bank. External sector, I think, is very stable. If anything, the first 4 months trade deficit has been slightly lower than last year. And there is an improvement in net services receipts, and the foreign exchange reserves are extremely comfortable, covering 11 months of imports. Gross FDI has been on an uptrend, and as we have repeatedly mentioned in several forums, net FDI, which was considered to be lower in last financial year, FY24, and also in FY23, actually reflected the health of the Indian market, providing very profitable exits to direct investors. And there was basically a change in the ownership from direct investors to portfolio investors with the exit of many direct investors in the last 2 years. So in other words, the decline in the net FDI did not reflect a loss of confidence in the Indian economy's prospects, but rather was an underlining of the healthy options available through the Indian capital markets for direct investors to make profitable exits, which should indeed act as an inducement for future investments. And that is what is reflected in the fact, as you will see in the next slide. But before I go there, on the right side, what you see is that by and large, in the last 14 to 15 months, we are seeing continued confidence in the portfolio investors, both into the equity and debt market in India, because the number of months in which the flows were positive far outnumber the months in which there was recorded outflows, and inflows are actually much larger than the few months which recorded outflows with respect to foreign portfolio investors. And domestic retail investors have also been providing us a considerable measure of resilience to Indian financial asset prices. With respect to the overall fiscal situation, as we saw in the budget release about a month earlier, the government has reiterated its fiscal deficit target. In fact, it brought it down from 5.1 in the interim budget down to 4.9 for FY25, and therefore the government is well on track to meet the targeted or fiscal deficit ratio of 4.5% or below in FY26. So what looked like a fairly ambitious target enunciated in FY21 at 9.2%, bringing it down to 4.5% or below in 5-year time frame is within sight of achievement. And there is continued focus on capital spending at 3.4% of GDP, and it's crowding in effect both in terms of the multiplier effects with respect to crowding in the private sector and also contributing to employment growth are beginning to materialize. GST revenues remain buoyant, as you can see on the right side. Capital goods imports maintain their steady share, and there is also a domestic increase in capital and infrastructure good production. You see on the middle chart here, the IIP capital goods index as well as the IIP construction infra goods index, both especially the construction infra goods index in April to June quarter has been rising steadily over the last 4 years. And manufacturing sector capacity utilization continues to expand and standing at 76.8%. And it does augur well for private sector capital formation. And that is what you see in the next slide. This is the data given by the Reserve Bank of India in its August monthly bulletin. And you can see a number of projects sanctioned and the total project cost based on the filings done by corporates through their fundraising in external borrowing market, domestic debt offerings, further placement offerings, IPOs, etc. So it's really a bottom-up aggregation here, which the central bank does once a year. And what you see is, after the trough in FY21, there has been a steady pickup in the number of projects which have mobilized finances through Indian and external capital markets, and the envisaged capex over the years has also been steadily rising. Therefore, this data coming out from the central bank should put to rest continued doubts and concerns being expressed whether private sector capital formation is indeed happening in the country. And if anything, despite the fact that the government capex may have been slow in the first quarter, the fact that we see that gross fixed capital formation in real terms was 34.8% of GDP, and in nominal terms was 31.3% of GDP, similar to last year's 31.4%, means that private sector capex is also playing its part in sustaining the overall share of gross fixed capital formation in an expanding GDP scenario. The banking sector remains in good shape with a very low non-performing asset share in the overall asset base, and non-food bank credit growth remains buoyant. The average growth rate in the first quarter is 18.7 compared to 16 and 12.2% in the previous two financial years. So in other words, both credit demand and credit availability signal no concern, and this also augurs well for growth rate to pick up in the coming quarters. Urban employment indicators have been declining, and the increase in net payroll additions under EPFO in the first quarter of this year have shown a significant jump. And now with the government announcing many new schemes for employment, incentivizing employment creation, especially in the formal sector through additions to EPFO for first-time employment, for employment in manufacturing, etc., this should see even further growth in the coming quarters and in the coming years as well. As far as the outlook is concerned, the growth momentum remains strong. The first quarter slowdown was anticipated due to the election and due to a slowdown in government spending as a result. But all components of demand side, excepting government final consumption expenditure, have indeed registered healthy growth. So there is strong investment demand. Business sentiment is remaining buoyant. There is healthy progress in monsoon rainfall and higher kharif sowing. Corporate and bank balance sheets are in good shape, improved fiscal balances as we showed you, and a budget focus on priority areas: agriculture, employment and skilling, human resource development, manufacturing and services, urban development, energy security, etc. I think therefore the budget also provides further boost to the continued growth momentum, and particularly with a focus on employment generation, skilling, agriculture, MSME sector and energy security. The medium term, therefore, the Indian economy can look forward to a great growth rate of 6.5 to 7 and opportunistically at 7% plus if we can build on the structural reforms undertaken. But on a baseline level, 6.5 to 7% growth rate is very realistic. 7+% growth rate can be achieved if structural reforms undertaken over the last decade are further expanded in the coming years as well. What can be the risk factors that might cause some slowdown in the expected growth rates in the coming quarters? Financial markets globally still remain elevated and volatile and uncertain in the light of political development that might still unfold in other parts of the world. and therefore potential financial market correction can have implications for sentiment. And therefore on private consumption. We have indicated this in the monthly economic review as well, which we publish at the Department of Economic Affairs. Then there is potential for escalation of geopolitical conflicts leading to disruptions in commodity supply and therefore higher prices. Monsoon, for example, if La Nina conditions set in later in the monsoon season in September, and if the rainfall continues well into October, then it may have implications for the kind of harvest one expects. And of course, the central bank's, Reserve Bank of India's survey of consumer confidence and also the industrial outlook survey that was published along with the monetary policy decision in the first week of August, they do point to a certain softening of sentiment, both with respect to the perceptions on employment and also in the overall index level and spending inclinations. We need to make sure that these slight softening that we saw in the August editions of these two surveys are temporary, and that both credit support and interest rate support are available to different segments of the economy to continue with their capital formation and therefore sustain economic growth. As it is, I think we have the projections of the central bank at 7.2%. Now, Moody's also has joined along with Fitch and the Central Reserve Bank of India in projecting a 7.2% growth rate. IMF and the Asian Development Bank stand at 7% as far as the full financial year FY25 is concerned. And World Bank, OECD, and the S&P are at the upper end of the range of 6 to 7%, closer to 7 rather than closer to 6.5% with respect to S&P, and slightly less so in the case of World Bank and OECD. So all in all, what we are seeing is that the Indian economy is sustaining the growth momentum and the pattern of sustained expansion we have seen since the end of COVID sometime in the course of 2021. And private sector is beginning to invest. We see it in the data on fundraising, projects launched, as well as in the index of infrastructure goods and capital goods imports, and in the sustained expansion of PMI and both in manufacturing and services. As far as consumption is concerned, its overall share of GDP has risen both in constant price terms as well as in nominal terms. And rural consumption has been steadily growing in the last 5 quarters. So we look forward to a period of growth built on the foundations of macroeconomic and financial stability and fiscal prudence that have been evident in the last 5 years post-COVID. Thank you very much.
Thank you, sir, for your comprehensive analysis. Now we move on to the question and answer session. So I request all of you, if you have a question, please post your query or raise your hand on the WhatsApp group. So we'll start with Kriti Ambe from Informis. She already said she has a question. Please go ahead with your question, Kriti.
Thanks, ma'am. Hi, sir. Good evening. Sir, just 2 questions. One, the GDP growth for Q1 is still lower than the RBI estimate, which was also cut in the August policy. So how would you explain that? And second, sir, services growth, if you look at the 3 subsectors and you see their growth together, it comes to 7.2%. And that has been lower than last year's growth. And this is the trend for the last 5 quarters. So what is affecting that, if you could explain?
The first quarter growth rate, the central bank had got it down to 7.1, and what we have now received is 6.7, but this was due to one-off factors. So possibly there will be a pickup, and the economic survey projects a growth rate of 6.5 to 7%. Now, as far as the tertiary sector growth being on the lower side year on year in the first quarter, as you point out, in the last 5 quarters, there was a very strong recovery in the tertiary sector in the first 2-3 years after the end of COVID in 22 and 23. And what we see here is that those high levels have been maintained. So naturally, the base has picked up very strongly. And as you saw in the data on hotel occupancy rates, etc. And also the financial sector growth rate was very strong in 22 and 23 due to credit growth. And while credit growth is still healthy, it is moderated from the levels we saw in 22 and 23. So therefore, that explains the slight lower growth rate of the tertiary sector in this year's first quarter compared to last year.
Next, we have Sapna, CNBC. Sapna from CNBC, please ask your question. Sapna, we can't hear you. Okay, then we move on to Meghna. Meghna, please ask your question.
Hi, sir. Sir, you said that there was a fear of food inflation spilling over to core inflation, which we have not seen this time. So, have we able to identify that what has prevented that, and has that fear still persists, like going ahead? Could we see a spillover?
No, I think it's a good question as to what has led to the lack of transmission or spillover of the food inflation to the other elements of the inflation cycle, so that we need to analyze. But it also is the fact that overall investment on the supply side of the economy, the capital investments, the improvement in supply infrastructure, and the fact that logistics costs have come down, etc. And I think we are probably beginning to see the effect of supply side improvements that have been made in the last 10 years, which is preventing the overall inflation rate getting out of hand, and also preventing core inflation from rising. A formal investigation is something that we will be undertaking. Yeah.
Arup Roy Chaudhary, Deccan Herald. Arup, kindly go ahead and ask your question.
Dr. Nageswaran, can you hear me? Am I audible?
I hear you, Arup. Yeah.
Yeah, all right. So, very good evening. I just wanted to ask, what would explain the year-on-year drop in growth rates in the primary sector, especially agriculture? It grew 2% in Q1 FY25 compared to 3.7% in Q1 FY24. Did the heat wave play a role there, or is there another explanation?
I mean, obviously, it also reflects the erratic monsoon. I don't think it reflects the heat wave of the April, May or May, June period. It reflects the fact that last year's monsoons have been volatile, and therefore Rabi crop was relatively, I think the sowing was, if I'm not mistaken, I'm quoting from memory, probably the sowing and the acreage was lower than previous the Kharif crop. So that probably explains the fact that agricultural growth, what it reflects is the fact that in the course of the harvest of the winter crop in January might have been on the lower side because of the monsoon volatility and it's not so great geographic spread in calendar year 2023.
Sapna, we come back to you again. Sapna from CNBC. Sapna, please ask your question. We can't hear you. So Sapna from CNBC wants to know, has the private final consumption expenditure come down? Is this a worry going forward? Has the private final consumption expenditure come down? Is it a worry going forward?
Private final consumption expenditure, if anything, if you look at both in constant price terms and in current price terms, has actually registered a good pickup actually rather than going down. And I think we also showed quarterly breakdown of how rural consumption has been steadily rising from the lows we saw in the course of 22-23 right up to the first quarter of 23-24. So if anything, I think the consumption trends are moderately healthy rather than going down.
Prakash Priyadarshi from ET Now, he also wants to ask a question. Prakash, please ask your question.
Yeah, am I audible?
Yeah, we can hear you.
Yeah, so sir, crude and fertilizer prices have remained range bound for quite some time despite ongoing conflict. And do you believe that the external factors, risk factors have diminished, or do the challenges for Indian economy persist?
Sure, I think the external supply side concerns have been largely offset by the fact that economic growth has been on the slower side in China. So therefore, the lower demand and consumption from China has played a very big role in crude oil prices remaining within a certain range. At the same time, we do expect that crude prices will remain in the current range. We don't see it as a baseline factor that it will be a higher. No, so we only mentioned it as the risk factor. There is no anticipation in our baseline scenario that we will confront higher crude oil prices.
Thank you.
Any more questions, please? Or otherwise, we'll wind up the media briefing.
May I ask one, Siddharth this side from Bloomberg?
Yes, Siddharth, please go on.
Yeah, good evening, Mr. Nageshwaran. My question is on a slightly different note. We've been seeing two external MPC members at RBI. They have been saying that we should have a rate cut now because that might impact growth. So what's your take on that?
I have never commented on monetary policy decisions on the deliberations of monetary policy committee in public, so and I continue to maintain that stance. You should probably be posing the question to the two MPC members or others in the MPC.
Sir, there is a question from Ruchika from Business Standard. Can you explain why the GVA growth is higher than the GDP growth?
They are both statistically insignificantly different this time.
Anybody else with a question? Yes. Anybody
Ma'am,
else?
I have a question. I'm Banikinkar Patnaik from the Economic Times.
Hanji, please go ahead. Kindly ask your question.
First of all, if you think about it, banking is probably one of the few industries globally that still continues to use technology that was written before.
Hello?
Am I audible, sir?
Yes,
you were
please.
audible, but at some point you stopped, yeah.
Yeah, I thought there was some audio somewhere. Okay, sir, just wanted to ask you about this private final consumption expenditure. The growth seems to be reasonably good. So how do you see it panning, in the second quarter, both private consumption and investment? Plus, sir, the construction sector has witnessed a double-digit growth. So do you think it's actually, translating into employment prospects?
Yeah, I think we showed you the chart on the net new additions to EPFO and also the urban unemployment rate. And we also mentioned that many of the incentives announced in the budget will translate into higher employment. And regarding the fact that private final consumption expenditure and gross fixed capital formation have done quite well in the first quarter, and in the light of a favorable monsoon, and based on the impact of the budget announcements, etc., leading to employment generation and income growth, we do expect healthy growth trends in private final consumption expenditure. As far as gross fixed capital formation is concerned, that should also actually do far better because government budget spending was 11.1 lakh crores, and private sector capital formation, as I mentioned repeatedly, is also doing well. And you saw that with respect to the central bank data on project sanction and number of projects filed for investment spending in the coming years. And therefore, I think our expectation is that these two will also register healthy growth trends in the coming quarters.
Thank you, sir.
So I think with this we come to the close of the media briefing. I would like to thank the CEA sir for his comprehensive overview of the quarterly data, as well as putting into perspective the various parameters. And I thank you all for joining the media evening. Thank you very much. Thank you.
Thank you from my side as well.